looks normal, everybody does it, but in most cases costs you a lot of money on the long run, about 190,000 over 30 years. Now, how could we have done this better? Let's have a look. Let's have a look today at what happens when you buy a second property, you rent out the first one, and you move into the new property. Well, the way that people do it, which we're going to go through in a second, looks normal, everybody does it, but in most cases costs you a lot of money on the long run. In this example, it's about 190,000 over 30 years, which is really significant. But we can avoid that pretty easily, so let's go through that. Firstly, if you look at the example we have on the screen, let's look at how most people do it. So they've got their property at 800,000, and they say, hey, we want to buy a bigger property, so we're going to buy a $1.2 million property, and we're going to rent the property we have out currently. And the reason people usually do that is, one, you already have the property, so why not? Two, you don't have to pay selling costs and stamp duty. So we would assume, or you would think, that makes it a better investment property because you're already saving 50,000 straight up. Now, if you were to just go ahead and do this in a normal instance, what you would end up doing, so you start off with your owner-occupied loan of 300,000 over here. And then in most cases, so that one would have to swap to an investment loan because we're now renting out the property. And then we need to borrow money for our new purchase. So our new purchase is gonna cost about 1.25 million, 50,000 in stamp duty, etc. 1.2 million for the purchase price. So we need to borrow that from somewhere. So we'd usually borrow 80% of the purchase price, 960 against our property. And then we draw out equity against our existing property of 290,000. And that's how we'd get our money, and that's how we purchase the property. And this is super normal and probably what you're considering yourself, but there is better ways to do it. So there's a couple of important things to understand here. Firstly, yes, we're ending up with essentially 3 loans. That is the correct way to do it. There is a way where you can end up with 300,000 here and 1.25 million over here. It's gone behind my face. Don't do that. That's called cross-collateralization. If someone offers you that or you're not sure, I do have a whole page on cross-collateralization, but it's really, really bad. So if you don't understand why I've set it up this way, probably it is worth having a look at that page and understanding that a bit better. But otherwise, as long as this makes sense to you, you draw the equity out and you borrow against a new property, that would be the correct way to do it. The other thing we have to understand is whether a loan is investment or owner-occupied here. So this one is investment, and that's because the purpose of it was to purchase this property originally, even though that was 10 years ago, which is now an investment property. So that is an investment loan, and this is tax deductible. However, this one over here is owner-occupied. Even though we're securing it against what is now an investment property, the purpose of the loan is to purchase an owner-occupied property over here. So the purpose of this loan is owner-occupied, as is this. That is how the banks view it, and that's also how the ATO views it. So that's really important. It's based on the purpose. It doesn't have anything to do with the actual security, i.e. which property it's secured against. So let's see what this means from a cash flow point of view. So this 300,000, as we said, this is now tax deductible. The rest is not. So here, and I'll show you at the end how to calculate it for yourself, do your own figures, etc. But a nice simple example, we have a single applicant, 150,000 gross income. We'll say they get 36,000 rental income from their new investment property, or the existing property, so they have a total income of 186,400. Now the tax deductible portion is 300,000, and at 6.5%, that means they get an annual deduction in year 1 of 19,500. So when they lodge their tax return, or if they do a PAYG variation, they can claim 19,500 as a deduction. That makes their annual tax payable 50,000, and that makes their net income, after considering the income from the rent and PAYG, they get a net annual income of 136,242. So let's remember that figure. And the other thing to note here, total loan is 1.55 million. That's just something I'll circle back to. Now, how could we have done this better? Let's have a look. What if we instead sell the property and then buy 2 new properties, an owner-occupied and investment. Now, before I go through what we've done here, a couple of things. I've deliberately done an $800,000 investment purchase. That may not be the best for you, but I wanted to make sure I compare apples with apples, so we're comparing exact like for like. The other thing is I've made sure that the total loan is $1.55 million as well, again, so that we can compare things correctly. So in this case, we've got the same thing on the left. We start with our owner-occupied property with a loan of $300,000. We sell that and we get proceeds of $480,000, so we lose $20,000 to real estate agent plus conveyancer, etc. And then what we'll do is we'll put our full $480,000 into purchasing a $1.2 million owner-occupied property. Now this is going to cost us $1.25 million, so we take out the $480,000 cash we have. We need an owner-occupied loan of $770,000. Then we want to go and buy our investment property over here. So firstly, we'll borrow 80% of that against that, and then we'll also get $140,000 out here. And the reason it's $140,000 is so that I can get this total loan the same, so that we can compare this correctly with the other situation. Usually you would borrow a bit more, but in this case it's $140,000, which means total investment loan is now $640 plus $140, so $780. Now that is our investment loan, and that is tax deductible. Cost to purchase, so $832 it will cost us to purchase this investment property. So realistically, you're going to have to put, this should say $52,000, $52,000 cash in. And again, I would always borrow that $52,000 realistically, because you could do that, but that just messes with the math a little bit. So in this case, you lose $52,000 to set this up, but now you have a $780,000 loan against the investment or deductible loan and a $770 owner occupied. So what does this actually mean? So let's have a look at a few things. Let's first look at our initial losses. So we lost $20,000 when we sold it, and then we paid stamp duty on the new property. There's probably a couple of thousand more there, but roughly our loss is $52,000. Straight up, year zero, day zero. That's how much we're going to lose to do this. But let's look at what happens to our income now. So we have the same PAYG income of $150, same rental income because the property is the same value of $36,400, total income of $186,400. Now we have a tax deductible portion of $780,000, which means that the interest on that in year one, $50,700. Once you put that in your tax return as a tax deduction, you actually end up paying only $37,990 tax, which means your net income is $148,000. Now, if we compare that, which we do here we have the first scenario I did, where you kept your property, and on the right we have the second one where we sold and rebought. So let's compare them side by side. You lose $52,000 as we discussed, which is a combination of selling price and stamp duty. However, we get $12,000 net income per annum additional, and that's just because we have a bigger tax deduction at the end of the year. So it's not quite the whole story, because that $12,000, it diminishes over 30 years. As the loans decrease, the benefit decreases. So we still want to see what it looks like in the future. But luckily for us, I went full nerd on this, and I made a huge spreadsheet. Took me far too long. I'll never do it again. But I actually compared year on year. As it diminishes, you can see that the $12,000 does decrease over the years, but you can also see the benefit. So year one, we lose $52,000, but we've gained within 5 years, we are ahead. So we've got our full $52,000 back. And yes, we are out of pocket $50,000, which could have gone in an offset account. If it had been in an offset account for 5 years, we would have saved $20,000. But nevertheless, we've got our $50,000 back within 5 years. And from there, the gains are massive. Even over the full 30 years, you get down to $190,000 benefit from doing it this way. And here you can see our nice pretty graph. We hit zero around about 5 years. It actually looks a bit bit wonky, but that is the same as this table. And then the benefit just keeps going up from there and slowly diminishes as we approach 30 years. But either way, the general premise here, or the general things to understand, if you are going to be holding a investment property for 10, 20 years, it is very likely better to restructure it now. Make sure that you're borrowing, in an ideal world, 100% of the investment costs and minimizing your owner-occupied debt, because you'll end up with a graph like this. If you hadn't done this, so if you did this a few years ago and you wish you did do it, it doesn't really matter. You can do it at any point. If you're at that stage and it was 3 years ago where you did this, you can still sell your investment property now. You can put all your money into paying down your owner occupied and then get a new loan for a new investment. So either way, it is probably worth it. If you were going to retire within 5 years, I would say no, don't do this, hold the property. If your income's going to decrease significantly, then also hold the property, because the tax deduction is not very useful if you don't have a high income, or if you have no intention of being in the property market from an investment point of view for a long time. Again, hold the property for a few years, sell it, and then you're done. But if you're ever going to hold it for a long time, the sooner you can restructure it to maximize the investment portion, the better. And generally the only way to do that is to sell down whatever you have that doesn't have a lot of debt and reborrow 100%. And I will clarify that it's not always better. So this graph makes it look like you should always sell and rebuy. It's not always better. It really does depend on the values of the property, the loan amounts that you've got, your taxable income, your partner's taxable income. So we'll go through how to calculate it soon. It is beneficial to sell and rebuy in most cases, in my experience. But it's not always the best. So you do want to actually look at, if you sell and rebuy, what does that actually do to your income compared to how much is it going to cost you? There is other benefits. So if you consider doing this, you get the tax benefits, which is what we've just gone through. Selecting a new property. So I think that's really important. Most people that buy a owner-occupied property, they buy their first property and it's somewhere that they want to live. And then they'll buy a bigger property, which is usually in the same suburb or nearby, rent out their first one. That's quite bad from a diversification point of view. Two properties very close to each other geographically isn't ideal. But the other thing is you have all of Australia to invest in, so probably that property you had is not a great investment property. You could probably spend some time to research, and you can find somewhere anywhere in Australia and buy that. You can also restructure it. So in this example, you don't have to go and buy an $800,000 property. It might be better to buy two $400,000 properties regionally. You can basically reset it up how you want to and how it's going to be more beneficial. And you can actually use the tax benefits as justification for doing this, because it will be better for you in the long run. And finally, when you do, or if you do sell and rebuy, you can consider whether you put the properties in a trust. Now, the calculations get weird with negative gearing and the benefits a bit delayed if you do that. That's a whole nother topic, so I'll put a link somewhere around here for a video to that, but there are definitely benefits and you should consider it if you are buying an investment property. And doing your own calculations. So firstly, let's talk about what I actually did and where I simplified things. So I didn't consider things. If you really wanted to do this seriously, you could put in other deductions, so repairs, rates, etc. You could try and consider changes in interest rates, additional payments. It gets very complicated, but I haven't considered any of that in here. A joint mortgage works a little differently. So if it's in your personal name and the title's in 50-50, then you need to apply the tax deduction 50% to each person when you do these calculations. And then finally, I use 6.5%, and that's just where the interest rates are roughly right now for investment. If interest rates get lower, the benefits of maximizing your tax deductible income mortgage get lower, but if interest rates get higher, the benefits are better. So we don't know what it will be in the future, and we don't know that you're actually going to get your $50,000 back in 5 years. Maybe not if interest rates drop, but I would hazard a guess that it will probably be beneficial. So at least consider it. Now, actually doing the incomes yourself, because I'm not going to do this for you. Basically, paycalculator.com is your friend, but let's firstly look at calculating interest. So we can help you figure out how you can maximize your tax deductible debt, but for the most part, you basically, any cash that you have available, put that into your owner occupied. And then once you've done that, then you reborrow 100% of the investment cost. That's the general premise of figuring it out. Figuring out the interest per year is super easy. You got a $300,000 loan, 6.5 interest. You do 300,000 times 6.5 divided by 100, 19,500 interest in the first year. And then how you would figure this out, you take your income. So if your income was 200,000 and your rent was 40,000, you'd put 240,000 in here into paycalculator.com, and then down here you can put your tax deduction, so you can see what this 19.5 will actually do for you, and it'll tell you there's an income tax saving. Here is your net annual income, and if you restructured it so you had 50,000 in deductible debt, your net income's about 17,000 higher. So do use PayCalculator. I use it for everything. It's very, very good. And if you need anything else, the website has pretty much everything I just talked about.